Good morning. Welcome to the presentation. Today is Saturday, July 31st, 2010. Today we're going to look at the broader market. We'll review our open positions, then we'll scan for a new stock, analyze that stock, and if it's appropriate, build a new position. We're going to use the AP software to do our analysis. First, we'll take a look at a macroeconomic calendar. We see that on Wednesday, July 28th, the durable goods orders report was released at 8:30 a.m. Eastern. Consensus range for the new orders month over month was 0.4% to 4.0%. The actual number was not as expected. It came in at negative 1.0%. We received a GDP report on Friday, also before market open at 8:30 a.m. Eastern. Real GDP numbers quarter over quarter were expected to be within the range of 1.0% to 3.4%. The actual number was 2.4%. And the GDP price index quarter over quarter change was expected to be between 0.4% and 0.5%, and that was well outside the range of 1.8%. Now let's take a look at the broader market. We'll take a look at the watch list here from the AP software. We can see that the Dow, NASDAQ, and S&P 500 all closed flat on Friday, and the S&P 500 futures contracts show that the S&P closed at 1098.25. The Dow Jones Industrial Average, the NASDAQ 100, and the S&P, as well as the Russell 2000, all show similar patterns. Note that gold had a very strong run-up on Friday, and crude oil has been hovering between the 75 and 80 point for more than a month, almost 2 months. We'll make note of the current levels of volatility. Note that the VXX is currently at 2257. It is slowly moving down in range. And the value of the US dollar is moving down in relation to the basket of 6 other major world currencies. Both the 30-year bond and the 10-year notes had a big jump on Friday. The 30-year bonds increased by almost 1.5%, and the 10-year notes increased by 0.6%. Now let's move on and look at our paper portfolio. We trade a portfolio of income trades with our group of students. We reset that portfolio every calendar year on January 1st, and our current portfolio is up 24.27% year to date. We have a variety of positions open, most of them income trades, some of them more basic, some of them more advanced. We're going to look at our intermediate positions today. We'll start with our Apple position, which is currently up $791. Our FDX position, FedEx, is up $31. We've been in this just for a couple of days. Our gold position's up $62. TBT's up $220. Our USO position we won't be looking at closely today. This is an advanced position we're doing with our more experienced students. Our VXX position is down $15, and our Walmart position is up about $100. Let's look at each of these positions individually. This is our Apple position. We opened this position about 3.5 weeks ago. We are currently up $805.18, and the margin requirement for this position is $3,040. That's currently a 26.5% return. Gamma risk is increasing, and in fact it's getting pretty high. We should close this position on Monday if there's any kind of pullback. What we'd like to see is the underlying asset move down to about 252, so we're at the zenith of this curve, and that would be the ideal time to close. However, because we're so close to expiration time and gamma is increasing on this position, we should close it and take our profits. Our next position is FedEx. We are in the perfect position. We're currently up $41. This position has a maximum potential profit of $168, and it cost $1,332 to enter. This is a fairly high probability, low ROI position, but we are going to hold this for about another 2 weeks and then take whatever profit that we have. If the underlying asset moves down below about 77 or above 87, we will adjust the position or simply close the position. We also have a position on gold. Gold's currently at $115.49. Our position is up $68.64. This position cost $865 to enter. So we're currently up 7.9% on this trade. Again, we're at the ideal position on this curve. The width of one standard deviation is well within the range of our strike prices. We entered this position when implied volatility was very high, and it's been coming in since that time. The market had been moving down, gold had been moving down. You'll recall from our charts that gold had a very strong move on Friday, so it's moved it right up to the center point of our trade. We'll stay in this position for another couple of weeks. We have a position on TBT. We're currently up $230. This position has a maximum potential profit of $650. We're going to stay in this position. We don't expect any major moves in TBT unless the U.S. Treasury does something unexpected in the next few weeks. So we'll let this one run. We have a position on USO. This is a multi-month position where we're rolling strikes. We're not going to discuss that in detail today. This is our VXX position. This is really two positions. The first position is a long call. We're down $2 on this. Our expectation is that the VXX will have a spike sometime in the next month up to $28. If this happens sometime soon, we'll have a very good ROI on this leg. And that leg is coupled with a bull put spread. It's a bullish position, also designed to take advantage of a spike up to our expected 28 or above. If that happens, we'll make about if that happens Monday, we'll make about $56 on an $85 trade. That's about a 65% return, as well as whatever money we make on the long call. And our last position is a Walmart trade we made several weeks ago. We're currently up $105, but we've protected ourselves on the upside in case something unexpectedly good happens in the broader market. If Walmart pulls back $2, we'll be at the zenith, and we will immediately close this position and capture several $100s. We have a maximum potential profit on this trade of $370. On the downside risk, if the underlying asset happened to go to 40 and we fell asleep at the wheel and let it drop, would cost us our entire margin requirement of $4,600. We, of course, would never let that happen. If the underlying asset gets anywhere close to our upside strike, we'll be down about $200. We would certainly adjust, close the position, or roll to the next month. If it moves down, if it gets below about 48, we would simply close and take our $100 or $200 profit. Okay, now let's do a scan and see if we can find a new trade for next month. We're going to use the AP software, come down to the scan section. We'll be looking for a large cap, low beta stock. Last month we traded McDonald's MCD. We entered a position, held it for 11 days, and made 13.7% return. Those two videos are also available if you'd like to see how we did the analysis on those and how we tracked and managed those. Let's take a quick glance at these and see if we see anything that looks attractive. We haven't traded Heinz for a while. Let's take a look at this. So the very first thing that we'll do is look at the 3-month chart and find the more recent intermediate term supports and resistance. Note on this 3-month chart that we have resistance around the we have support around the 43 level, and we have resistance around 47, so between 46, where we've had 2 recent peaks, and 47, a longer term peak. So the range is from 43 to 47. This is a relatively low beta stock, has a beta of 0.6. So let's go ahead and do full but abbreviated analysis on Heinz. We'll put in the symbol first, and we'll look at a series of charts. Click the charts button. Let me get rid of this menu. What we have in the upper left is a monthly chart of Heinz, and we can see that over the last several years it hasn't been lower than about $28 a share, and it's been as high as about $47 a share. The most recent, within the last 3 months, the most recent peaks were around 47, which is very similar to the peaks at the peak of the market in mid-2008. This chart is a weekly chart, and we'll note that for about the last 5 months, Heinz has been bouncing off that $47 point. And this is that 3-month chart that we looked at just a moment ago. On the daily chart, we can see that in the first week of July, Heinz had hit and bounced off the 200-day simple moving average. It is currently just below the 50-day moving average. We should have pretty good support between 43 and 44. and we should have pretty strong resistance around 46.5 and 47. So we're going to use those 2 points as guides when we do our analysis. To do that analysis, we'll type the symbol in again and click the research button. What that will do is bring up a series of tabs. We've already looked at the chart, so I will close this tab. The next thing we'll look at is technicals. This is a series of automated technical indicators, and we're going to use this information to build an overall picture of Heinz. What we're looking for is anything that stands out as being particularly bad that would drive us to the conclusion, lead us to the conclusion that we should not enter this trade. I will never make a trade based solely on this information, but I will use this information to build a larger picture. So we can see from this information that there's a short-term 40% sell rating on the stock, a medium-term 75% sell rating, and a long-term 67% sell rating. What essentially this is showing us is that the stock has been moving down for several months, and we can see that here, very, very shallow downtrends.